Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Wednesday, July 29th, 2026, and we have a packed show. The global chip sell-off is deepening. The Fed concludes its two-day FOMC meeting today with the rate decision due this afternoon, and crypto is heading into this window with its least downside protection in weeks. Let's get right into it. Lizzie, South Korea's Kospi just posted one of its worst single-day drops on record. Samsung and SK Hynix down 13 to 14%, and it's hitting our futures hard this morning. What's the core fear driving this sell-off?
Morning, Robert. The core fear is straightforward. China is closing the gap in semiconductor manufacturing faster than the market expected, and investors are repricing the entire AI memory trade as a result. Changxin Memory Technologies debuted on the Shanghai Exchange and surged nearly 470% on day one. And separately, there are credible reports of a Chinese state-backed firm mass-producing domestic DUV lithography equipment that directly threatens ASML's competitive moat. The market is realizing that the premium it was paying for US and South Korean chip dominance may have been overstated, and that repricing is violent. Nasdaq futures are down about 1% this morning, and the SOX ETF is extending its slide for a third consecutive session.
Nvidia has shed roughly $250 billion in market cap over 2 sessions and lost its crown as the world's most valuable company to Apple. Is this a buying opportunity, or does it signal something more structural?
That's the central question traders are wrestling with right now. The bull case is that Nvidia's fundamentals, data center demand, AI infrastructure build-out, the CUDA software ecosystem haven't changed overnight, and a $250 billion drawdown in 2 sessions is an emotional reaction to a competitive threat that will take years to fully materialize. The bear case is that the market is beginning to assign a legitimate China discount to the entire US AI supply chain. And if ASML's moat is cracking, Nvidia's pricing power on high-end GPUs could face similar pressure down the road. Most traders are treating this as a wait and confirm situation rather than an aggressive buy. The stock is showing no technical support level holding yet, and sentiment on QQQ has deteriorated to extremely bearish on StockTwits, which tells you how much risk appetite has evaporated around the Nasdaq names.
Which names in the chip space are you watching most closely as potential trades today?
SanDisk is the one I keep coming back to. It was the S&P 500's biggest loser on Monday, down 11%, and it dropped another 4.5% overnight, which suggests the selling pressure is not exhausted. Micron is worth watching because it has direct DRAM exposure that overlaps with exactly what Changxin is threatening. On the equipment side, ASML is critical. A 6% single-session drop on reports of domestic Chinese DUV production is a significant signal because ASML's entire moat has rested on being the only company capable of producing extreme ultraviolet lithography machines. And if that story is even partially compromised, the multiple compression could continue. Broadcom is a different case, up over 700% since 2021, carrying 76% gross margins and trading at 24 times forward PE. But it has meaningful AI custom chip exposure that could benefit regardless of the memory competition narrative, so a pullback there might actually create a more interesting entry than the pure memory names.
We also have major earnings out today: Boeing, PayPal, Coca-Cola, Ford, and Visa. Which report matters most to you from a trading perspective?
Visa is the one I'd prioritise from a market signal perspective. It's a real-time read on consumer spending health, and with consumer confidence recently beating estimates, a solid Visa print would provide some reassurance that the demand side of the economy is still intact, even as the tech trade gets shaken. Boeing is a wildcard, given its ongoing operational challenges, but Ford's guidance will matter for anyone trying to gauge how tariffs are actually hitting manufacturing margins in practice.
Steve, the Fed concludes its two-day FOMC meeting today with the rate decision due this afternoon, and markets are pricing a 33% chance of a hike under new chair Kevin Warsh. What does the macro data backdrop look like heading into that decision?
The backdrop is genuinely complicated, Robert. Last week's initial jobless claims came in at 187,000 against a forecast of 212,000 and a prior reading of 209,000. That's a significant beat that signals the labor market remains quite tight, which gives the inflation hawks on the committee real ammunition heading into this afternoon. The Consumer Confidence Index came in at 54.4 earlier this month against a forecast of 51, beating expectations and suggesting households aren't panicking despite elevated energy prices and the geopolitical noise around US-Iran tensions. At the same time, with tariffs still in place domestically, new Chair Warsh has a genuine case for tightening if core readings stay elevated, and the market sitting in a 33% hike, 67% hold split creates volatility because there is no consensus to anchor positioning ahead of the 2 p.m. Eastern announcement.
Tomorrow brings Q2 GDP, core PCE, and initial jobless claims all on the same morning. How significant is that combination in the context of what the Fed is weighing?
It's about as consequential a single morning as you'll see outside of a non-farm payrolls week, Robert. The Q2 GDP advance estimate drops tomorrow at 8:30 a.m. Eastern, and the June core PCE, which is the Fed's preferred inflation gauge, releases simultaneously alongside initial jobless claims. The jobless claims forecast for tomorrow is 200,000 against last week's 187,000, so the consensus is expecting a modest softening in labor market conditions. If GDP comes in strong and core PCE prints hot on the same morning that claims tick up, that creates a genuinely difficult signal for the market to interpret. Strong growth and persistent inflation with a slightly softer labor market is exactly the scenario where Warsh's reduced forward guidance approach amplifies volatility, because there is no clear playbook for how the Fed responds. Traders should be prepared for significant repricing across rates, equities, and crypto tomorrow morning, regardless of what the Fed delivers this afternoon.
Lizzie, over to crypto. Bitcoin has slid to around $63,200, and we saw over $630 million in leveraged liquidations in 24 hours. How exposed is crypto heading into today's Fed decision?
Quite exposed, Robert. Bitfinex analysts flagged something important. The 30-day put skew collapsed from 6.5 volatility points on July 14th down to just 2.2 by July 23rd, meaning traders reduced their hedges during the mid-July rally and never rebuilt them. So you have a market that's essentially unhedged, walking into a Fed meeting where a rate hike is a live possibility, and the macro win score has deteriorated sharply to negative 2.89, signalling broad risk-off conditions. There's also a significant supply wall sitting at $68,000, where roughly 3.55 million BTC are clustered from purchases over the past 6 to 12 months. So the upside is capped in the near term, even if sentiment improves. The correlation between Bitcoin ETF flows and daily price moves is running at 0.75, which means institutional ETF demand is the primary driver right now, and that demand thinned dramatically last week to just 373 BTC versus 943 BTC the prior week.
Ethereum is actually outperforming Bitcoin, up 24% over the past month versus Bitcoin's 8%. Is the ETH/BTC ratio move a genuine signal, or just relative strength in a still weak market?
It's a genuine signal worth taking seriously, though with important context. The ETH/BTC ratio has climbed to a 3-month high near 0.30, and Bitmine's Tom Lee is calling for $2,500 ETH site as a next target, with $2,000 as the immediate resistance level to clear. ETH is currently trading around $1,950 after pulling back with the broader market. Bitmine itself purchased another 9,946 ETH last week, bringing total holdings to nearly 5.8 million ETH, representing about 4.8% of circulating supply. The structural bull case for ETH is that staking yield and DeFi activity create organic demand that Bitcoin doesn't have, and options markets are pricing an ETH to target of $3,200 by year-end. That said, in a genuine risk-off scenario, triggered by a Fed hike this afternoon, ETH and SOL would both sell off hard alongside Bitcoin, regardless of relative fundamentals. Solana is already down over 4% in the past 24 hours amid a broader altcoin flush.
The Senate delayed the Clarity Act in favor of a Russia sanctions bill, and Scaramucci is giving it only a 40% chance of passing this year. How significant is that for institutional momentum in crypto?
It's a meaningful setback, Robert. The Clarity Act was the single most important near-term institutional catalyst for the space. Analysts had suggested Senate passage could push Bitcoin towards 68,000 on its own, and names like Coinbase and Circle would have benefited directly from the regulatory clarity it provides around digital asset classification. ARK's Cathie Wood was buying Circle shares this week, and Clear Street maintained buy ratings on both Coin and CRCL despite cutting price targets, which tells you the long-term thesis isn't broken. But with the August recess beginning next week, and the bill now pushed past that window, institutional buyers who were waiting on regulatory certainty have one less reason to deploy capital right now, and that removes a potential flaw from the market, heading into what is already a high-stakes period between today's Fed decision and tomorrow's GDP and PCE data.
That wraps up today's Morning Bell. This is not investment advice. Do your own research before making any financial decisions. And don't forget to subscribe so you never miss a morning. See you tomorrow.